Welcome to today's presentation. My main name is Peter Yusuf, Senior Market Analyst at IronFX. Now, in front of your screens, you will have your USD's daily chart. We will be mixing technicals with fundamentals today, as always. And once again, let me remind you that should you want to have a look at any trading instrument on technical level, write about it in the chat box, and if we have time, we'll have a look at it today. If not, we can always cover it tomorrow. Main issue on a fundamental basis for the market today is expected to be the release of the Fed's meeting minutes. That's in the late American session. And I would dare to say that the weakening of the US dollar over the past 3 days, actually since Friday, may have been a result of the increased expectations of the market for the Fed to start cutting rates in the September meeting. Please note that the market expects also the bank to cut rates in the November meeting and deliver a double rate cut in the December meeting. So it's not only about cutting rates in September, but a continuance of a strong dovish rate cutting path on behalf of the Fed. So the Fed's meeting minutes is a document which is expected to be scrutinized today by market participants and analysts alike. Overall, should there be sufficient, and I stress the word sufficient dovishness here, in the document, then we may see the market's expectations being verified, and in such a case, we may see the USD weaken further. On the flip side, should we see increased hesitation on behalf of some Fed policymakers to actually proceed with extensive rate cuts in the next 4 months, in my opinion, that could be signaling more or less that the Fed may be resisting the market expectations, or at least may be prepared to make some rate cuts, but not follow these extensive rate cutting expectations of the market. In such a case, the market may have to reposition itself, and that could provide some asymmetric support for the USD. However, the release as such is not only expected to affect the FX market, it's expected to have ripple effects also in US stock markets, probably also gold, and to a lesser degree could affect somewhat oil prices. And let's not forget that the release of the Fed's meeting minutes today is not the end of the story until the end of the week. We also have Fed Chairman Powell's speech at the Jackson Hole Symposium, which has been repeatedly highlighted by analysts over the past few days. And that may also create some divergence or at least some volatility for major pairs. Now, on a technical level against the euro, we note the steepening of Euro USD's ascent over the past 3 days, 3 trading sessions, and that would be Friday, Monday, and Tuesday. During today's Asian and early European session, the pair seems to be correcting a bit lower, just before the 1.1140 resistance line. It should be noted that the price action of Euro USD was able to practically almost cover the distance between the S1 and the R1. Overall, the bullish outlook is still present, and we're basing that practically on the upward trend line, which is continuing to guide the pair higher. I would be also noting here the fact that we have the RSI indicator, which is slightly above the reading of 70, implying a very strong bullish market sentiment. On the other hand, though, the fact that the RSI indicator has breached above the reading of 70 may also be implying that the pair is at overbought levels. And should such a notion surface, then we may see a correction lower. Similar readings or similar signals, if you prefer, we're getting also by the fact that the price action was able to breach above the upper Bollinger Band yesterday. And I think that's one of the reasons why the price action is correcting slightly lower during today's Asian session. Should the bulls maintain control over the pair, I would expect it to breach the 1.1140 and start aiming for the 1.1250. At the same time, we would be noting here that we tend to maintain our bullish outlook as long as the upward trend line remains intact. So even should the price action of Euro USD correct lower, it will not change our bullish outlook unless the upward trend line, which has been guiding the pair since the 8th, since the 2nd of August, remains. So for a bearish outlook, the price action has to drop, breach the S1 1.10, the pre-mentioned upward trend line, and start aiming for the S2. The possible bearish outlook is pretty high. It would be very difficult for the price action to actually reach that standards. We may see stabilization of the pair though, and in such a case, we may see the price action remaining between the R1 and the S1. Let's have a look at USD JPY. Now, JPY traders on a fundamental level, I would note two issues. The first would be the financial releases of Japan tomorrow during the Asian session. We're getting the preliminary PMI figures for August. Now, the preliminary PMI figures, I would be concentrating mostly on the manufacturing sector. If I'm correct, it was for July at 49.1. Should the figure drop even further, implying a deeper contraction of economic activity for the crucial manufacturing sector of Japan, could weigh somewhat on JPY. Macroeconomically, though, it would be signaling that economic activity in the Japanese economy is deteriorating, and that definitely will not be looking out on a macroeconomic level. I would be also noting tomorrow during the Asian session the release of Japan's chain store retail sales. The release concerns mostly the demand side of the Japanese economy, and it's important in the following sense that the big issue about the Japanese economy is the resilience of inflationary pressures, and that has lots to do also with the demand side. So should we see an acceleration of the chain store retail sales, then we may be seeing practically some support building up for the JPY as well. And the second issue relates to the fact that traditionally JPY had ignored financial data. JPY tends to react independently of financial releases unless they are of very, very high impact. In my opinion, main driver behind the JPY would be BOJ's intentions, Bank of Japan. Now, to that end, I would be highlighting that on Friday in the Asian session, there will be two sessions of the Japanese parliament at which BOJ Governor Ueda is to be testifying and explaining practically about the rate hike in the bank's last meeting. I would expect BOJ Governor Ueda to more or less highlight the persistence of inflationary pressures in the Japanese economy. By the way, we are getting also Japan's CPI rates for July on Friday's Asian session. It's at the same day, so that could enhance the importance of Ueda's testimony before the Japanese parliament. And I wouldn't be surprised to see BOJ Governor Weather actually supporting the idea that we may see further restrictive moves on behalf of the bank regarding its monetary policy. Practically more rate hikes to come. In such a case, we may see JPY gaining additional support. The qualitative issue here is that over the past 3 days, once again, Friday, Monday, Tuesday, USD JPY has been dropping. However, that was more a result of USD losing ground rather than JPY strengthening. On Friday, we may see JPY gaining independently somewhat. And always bear in mind that on Friday we have also the Jackson Hole Symposium, so it's expected to be quite busy day for JPY. On the technical level, once again we're seeing the USD side of the pair losing ground over the 3 past candlesticks. Let's not forget these are daily charts, so each candlestick represents a day of trading. The pair has been gaining some ground during today's Asian session, refusing to actually test the S144.25. The RSI indicator, though, implies a different story. It remains just above the reading of 30 despite a correction higher, which in my opinion tends to imply continuance of the presence of a bearish sentiment among market participants for the pair, which could ultimately drive it lower. For a bearish outlook, I would require the pair to breach the S144.25 and start aiming for the S241.40. On the other hand, should the bulls take over, the pair would be breaching most probably the R148.50 and start aiming for the R251.95. At this point, I would be noting that the possibility of a bullish outlook is still remote. So we may be seeing the price action of USD/JPY moving upwards, yet remaining within the corridor set between the R1 148.50 and the S144.25 in a movement in a sideways motion. Such a scenario would allow, especially if the R1 is tested and holds its ground, would allow for a sideways motion bias emerging. Okay, let's have a look at cable, which tends to be pretty similar to the euro. Here you go. And it's even steeper. Actually, the rise of GBP USD is quite steeper than Euro USD, which more or less tends to imply a relative strength on behalf of the GBP. Now, the upward movement is intense. The RSI indicator has neared, despite correcting a bit lower than the reading of 70. It's very near and tends to imply that the bullish sentiment is still present for the cable. I would maintain my bullish outlook as long as the upward trend line remains intact. Let me adjust a little bit of the chart. For the time being, the R1 is holding its ground, the 1.3040. You can see how the level was tested yesterday, yet the price action is a little bit lower. Should the bulls maintain control, though, then I would expect the price action of cable to breach the R1 and start aiming for the R2 1.3140, 100 pips higher. On the other hand, a bearish outlook is pretty remote. As for a bearish outlook, the price action of cable has to start falling, breach the pre-mentioned upward trend line, but also has to breach the S1 1.2890 and start aiming for the 1.2775. Let's have a look at USD CAD. Now, USD CAD has an interesting movement, and I'm highlighting this because We had yesterday the release of Canada's CPI rates for July. Now, the release highlighted, or at least showed, that inflationary pressures in the Canadian economy eased further over the past month. And that was quite interesting. Allow me to drill into the 1 minute chart. And let's have a look at the market reaction at the time of the release. Give me a sec. Going back, further back. Now this is the American session. USD CAD. This is the moment when practically Canada's CPI rates for July were released. Once again, I remind you guys, they tended to slow down, both on a core and a headline level, and implying an easing of inflationary pressures. However, the slowdown was achieved year on year. On a month-on-month level, both rates tended to accelerate, core and headline. But the bearish effect, you can see it right here. You can see how at the time of the release in the following 10 minutes, USD CAD was able to rise around 29 pips. And that was just by the release of Canada CPI rates. But later on, despite some stabilization, the price action of USD CAD edged lower and lower and has reached practically another red candlestick in a chain of 1, 2, 3, 4. Today's fourth. It's characteristic that the USD is losing ground also against the Canadian dollar as well. Now, loony traders may be keeping an eye out today for Canada's PPI rates for July. A possible slowdown could could clip the bearish movement of USD CAD somewhat. So that would be an interesting release. But once again, the main release for USD CAD at this point would be the release of the Fed's meeting minutes for July. Another issue which would be of interest for CAD traders would be the path of oil prices. Oil prices seem to continue falling, which could be having an adverse effect on the Canadian dollar as well, on the loonie, given Canada's status as a major oil producing economy. For the time being, on a technical level, we're highlighting the bearish outlook. That's being based practically on two factors. The first would be the downward trend line guiding the pair lower. The second would be the RSI indicator, which has neared, it's actually at the reading of 30 practically, implying a rather strong bearish sentiment on behalf of the market for the pair. Also note how the price action since Monday has been flirting with the lower Bollinger Band, which may more or less have slowed down the bears somewhat for the pair. Should the bears maintain control over the pair, I wouldn't be surprised to see it breaching the S1 1.3590 and start aiming for the S2 1.3475. Let's have a look at AUD USD. So AUD USD continued to rise yesterday. It's correcting a bit lower during today's Asian session, in contrast to the Canadian dollar, which continues to weaken. In my opinion, the upward motion is still present and actually has steepened even further. The RSI indicator has corrected just a bit lower, yet remains very close to the reading of 70, implying the presence still of a bullish sentiment for the pair. On the other hand, the price action has breached above the upper Bollinger Band, which may force the price action to actually correct a bit lower. As long as the price action remains above the prementioned upward trend line, we tend to maintain a bullish outlook for the pair, in which case we may be seeing AUD USD starting to aim, if not reaching, the 0.6795. Once again, though, one catch for this difficulty is that the upper Bollinger Band may not allow the pair's price action to ascend as high as we have mentioned. So a possible correction is in the cards, but for a bearish outlook, a correction is not enough. The pair has to drop, break the 0.6710, break the pre-mentioned upward trend line, and reach as low, if not breach, the S2 6575. I know that the prerequisites set for a bearish outlook, as outlined before, seem to be a little bit harsh. In my opinion, I'm a little bit more conservative, and I would like to have more reassurance before opening any short positions here. Okay, let's have a look at USD CHF. So USD CHF fell, breaching the S1 0.8555, and we turn this into a resistance line. Let's go hunting for a new ultimate resistance level. We're going to go way back to find such low levels. I think we're going to be using the weekly chart here. We had to go as back as 2014. We're going back up until 2011. And to tell you the truth, I'm not so sure whether that's valid anymore, but that's how far we have to go. Now let's correct the labels as well. Back to the daily chart. Now starting with the R3, which is now set at 0.8920. Now there have been arguments, substantial arguments, whether the R3, as this pictured right here, at 8920 would be more or less sufficient. Some have even discussed the possibility of going from the R2 to the R3 up here in one swing. I still see a mid-level here, so I'm noting the R3. The R2, which is being set at 0.8750. The R1 at 8550. The S1 at 8330. The S2 at 80.85. Note how the support lines have a wider corridor between them if compared to the resistance lines. And that's also related to the fact that we have very little price action below the S1 0.8330. As you have seen, we had to go all the way back to 2011 to find another valid support line at S3. For the time being, we tend to maintain a bearish outlook, and we're basing that practically on three factors. The first would be the downward motion of the pair since Friday. The second would be the fact that the price action was able to breach the 0.8550 support line, now turned to resistance. And that level even seems to have provided some resistance during today's Asian session. So it seems that it has worked its part there. The RSI indicator is the third reason why we're keeping a bearish outlook, and despite correcting a bit higher, the indicator's reading remains just above the reading of 30, implying a strong bearish sentiment on behalf of the market for the pair. Let's have a look at US 500. Okay, it's time that we set new resistance support lines. Definitely the 5370 has to be turned into support line, as also the 5490. And the 5590. Setting the new resistance line at 5850. And another one at 6000. We note that the first resistance line marks a record high level. So practically we're entering uncharted waters for S&P 500 here. Let's correct the levels as well at 6000. And there's 2 at 5490. And there's 3, used to be a former resistance line not turned to support, would be the 5370. Let's have a chat about your stock markets. What you're seeing here is more or less repeated also in Dow Jones and and Nasdaq, where we have 1, 2, 3, 4, 5, 6, 7, 8 continuous green candlesticks, which seem to be interrupted by a red one during yesterday's session. It seems as if stock market bulls took a recess yesterday, and it's characteristic that the price action may be somewhat stable. Yet the bullish outlook could be continued, and in such a case we may see the price action reaching, if not breaching, the 157.20. May I also say here that the price action seems to be breaking the pre-mentioned upward trend line guiding the index. That's a valid comment. However, for a bearish outlook, I would require the pair to breach the S155.90 and reach as low as the 54.90 before actually considering any bearish outlook on this case. Okay, let's have a look at WTI. Now, WTI prices, despite having a downward tendency since the 5th, since the 13th of the month, seem to have been encapsulated in a sideways motion between the R1 and the S1. On a fundamental level, I would be highlighting here that we had the release of the AP weekly crude oil inventories figure. It showed a very slight increase of US oil inventories. It's not the increase as such which matters, or let me rephrase it. It's not the amount of the increase that matters, but the fact that the slight increase tended to signal that the US oil market may not be as tight as we had initially expected. And should the increase of US oil inventories be verified also by today's EIA crude oil inventories release, then we may be seeing some doubts among oil traders about the path of oil prices. Actually, in my opinion, that could weigh on oil prices. And at this point, I would be highlighting another issue as well, and that would be the negotiations for a ceasefire in the Middle East. As we're speaking right now, at least in my information, is that Israel has accepted a plan which was brokered between the two sides and suggested by the US Secretary of State, Antony Blinken. Hamas has still to accept it, and that tends to create a certain fact of uncertainty. The market seems to be pricing in such an acceptance. However, I think on a political level, Hamas may have some difficulty in accepting the plans, given that a number of thorns are still there. And should Hamas actually not accept it, that could be a problem and more or less could provide some support for oil prices. It's characteristic that US State Secretary Antony Blinken practically, I think it was on Monday, stated that it's the last chance for a ceasefire. So the stakes are high. Should the ceasefire agreement or ceasefire deal not be reached, then we may see an extension of the war, and in that case, we may see also an escalation on a qualitative level. So, on the one hand, Hamas has threatened that it will restart suicide bombings within Israel, while Israel, on the other hand, seems prepared to invade Lebanon in order to create a security zone at its northern borders with Lebanon and clear any Hezbollah nests. In any case, the uncertainty could rise about the supply routes of the international oil market, and in that case, we may see oil prices gaining substantially. On the other hand, if a possible deal is struck for ceasefire, then we may see oil prices falling further as market worries about the supply chains of oil on an international level would be easing even further. On a technical level, once again, we're highlighting the sideways motion between the R179 and a quarter and the S171.40. For a bearish outlook, I would require the commodities price to breach the S171.40. Mind you, this is WTI we're talking about, and start aiming for the S267.90. The RSI indicator remains between the readings of 50 and 30, implying that despite some easing of the bearish sentiment for the commodities price among market participants, the bearishness in the market, in my opinion, is still there. Let's have a quick look at gold as well. Gold, which seems to have some difficulty breaching above the R125, S125.10. Actually, the price action of gold has breached below the S1, turning it into a resistance line, possibly. But for a bearish outlook, I would require a clear break of the of the upward trend line guiding the precious metals price, but also a breach of the S2 2480. Nothing less. So that should sum it up from our side. Best wishes for solid trading.
So as per usual, before we get started, just a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the Forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. Um so firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long buyers traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. So you can see here, our sell side is on the bottom where the swing lows are. Buy side is where the swing highs are. So basically, it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of a candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and it's reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording, or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay, sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have um higher lows, or rather lower highs, since it's a downtrend. Okay, so next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels, or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my, let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. It shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear. So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so are prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw your starting point here, and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG, or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. Flip zones, and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity grabs, which we went through before, are basically the areas in which there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at VXY, just a random chart, how you basically implement the FVG indicator, okay, is okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay. So you can actually use these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, fair value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just going to share all the resources that we use. Um, so basically what I mean by a double fair value gap. So you can look at this website as well. But basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your BPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, yeah, to my chart here. So you can see that our fair value gap is in this area here. See, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, yeah, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix-up. But yeah, let me know if you have any other questions. Um, yeah, with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week, we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix-up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.